Hello and welcome to the Novum Insights webinar looking at by the way, can you guys see my screen at the moment as well? Oh.
Yep, I can see your screen.
Okay, that's nice. So, hello and welcome to the Novum Insights webinar, which is looking at the topic of tokenization. And as a research firm of blockchain and crypto, we decided to put together our 5-year finance thought leadership series, where we look at where the world is heading 5 years from now. And we've been spending the last 3.5, 4 years looking at all sorts of frontier technology markets, from blockchain to AI to fintech to whatever. But one of the, I guess, one of the great sort of exciting areas that we've always been super inspired by at Novum is tokens and crypto. And we brought along some of the sort of preeminent experts in Europe on this subject matter. So this is a sort of extensive data summary we've been compiling with our partners at CryptoCompare, we've sort of analyzed probably one of the really interesting takeaways of the last 3 fairly extraordinary months, which has seen this sort of mass lockdown due to COVID-19 concerns, and clearly a massive market crash and extreme volatility. And I think what's very, very interesting is BTC had initially performed pretty weakly. It crashed extremely hard, down more than 30% since after the sort of WHO called a pandemic, but then continued a very sort of strong market beating decline to the point where, depending on when you look at the price of BTC, it's almost reached above the or has gone above the price of that it was before the pandemic hit. And of course, this is partly due to the halving and partly due to widespread monetary intervention by both the central banks all over the world, which I think arguably, and we can get to that discussion later, has driven renewed interest in Bitcoin. I know James, who's here from CryptoCompare, will be potentially talking about BTC and gold. The other interesting things to bear in mind is of the major markets, the Dow Jones Industrial Average did particularly poorly, still down 20% pre-COVID, which for some of the world's biggest companies, or the 30 US selected important big companies, including Apple, Microsoft, and the like, which have actually outperformed. It's had a bit bath. The constituents include places like ExxonMobil, which obviously with the oil price crash has done extremely poorly. The FTSE has also fared relatively badly, down 15% in the last 3 months, and the S&P 500 actually is down 10%. Whereas if you'd one thing to bear in mind when we're talking about BTC as a better alternative to fiat is if you'd held your money in euros against the dollar, you would have still done badly against the world's reserve currency, but it's still near the 0% mark and can even fluctuate over a 3-month period. I think the interesting debate, and this is showing the historical data on Bitcoin halvings, and I think part of the excitement that got many people interested in the asset class is Bitcoin, after being initially mined, started a run that included the sales of pizzas and other Bitcoin folklore. But when Bitcoin began its first bull market was after its first halving, where the Bitcoins in supply are halved. And then it's typically after such an aggressive run-up has then gone into a bear market. In the first phase of BTC, I think you'll find many of the panelists today got into the market somewhere here, and then somewhere here to here, and then I think I vividly remember starting tracking crypto in around 2016, and this was a extraordinarily exciting time, not only because of the Bitcoin halving, but because of Ethereum, the ICO token boom, and derivatives, and much more that we'll talk about in this period. And then also a period that we've lived through was a pretty serious bear market, which we've gone through in crypto through 2019, which began picking up towards the second half of this year. And this latest rally, I think leaves many excited to what can come in the crypto markets. Interestingly, over this 3-month COVID period, BTC has been by far the outperformer of the top 10 cryptos. ETH has done pretty well. So in relative terms, I mean, it's still actually on a par with the Dow Jones Industrial Average, but huge volatile spikes upwards and downwards. But there's been some excitement in that community around Ethereum 2, the development of DeFi, and much more that I'm sure we're going to talk about. Then you've had the likes of Bitcoin Cash down 36%, EOS down 37%, XRP down 27%, Litecoin down 39%, Tezos down 23.3%, Bitcoin Satoshi's Vision down 31%, and the Binance coin BNB down 24%. At the same time, there's been, as ever in this strange asset class, there's been winners and losers in the top 100. And I think sort of it's interesting to look at the sort of more intriguing areas where you can get real outlier returns. So Streamer is a data science company looking at the sort of video streaming market and tokenizing that. Perhaps unsurprisingly, if you look at the likes of Zoom, that monetization's there. Numerain or Numerai is a very interesting token looking at sort of big data trading trends, and backed by one of the sort of veterans of the space, Union Square Ventures. And Hyperion, intriguingly, the fund that has had sort of significant NAV performance. I think an interesting one for this discussion that we're about to go into is the significant difficulties experienced by Maker, which is down nearly 50%. And we've already in our warm-up call had quite a good discussion about this. And then I guess the buyer bewarned nature of crypto. If you'd invest in Horizon, you could have also lost half your money during this period, or Hypercash. So the top 100 cryptocurrencies has always been a field where you can make pretty extraordinary returns on an IRR basis over a 3-month period, but also lose your shirt. So this is by Novum, and really we're going to launch into the discussion with our great panelists. I think we'll turn first to James Harris of CryptoCompare, who's one of the API partners we use at Novum, they're a great data set, and we've been sort of digging into them. So James, please go ahead and share a bit about your company and perhaps some thoughts on the trends of what we've been experiencing.
Yeah, thank you, Toby, and it's a real pleasure to be on, and congratulations on the launch of this webinar series. Nice, interesting times we live in and to be doing it in. I'm James from CryptoCompare. I'm the commercial director here, and CryptoCompare is the world's leading digital asset market data company. So think of us like a Refinitiv or a Bloomberg of digital assets, and that's probably the best way we can think of it. I feel like I'm a little bit of an odd man out here. I've got some people here that go in great depths into the tokenized world, and I'm more of I suppose, a macro overlay. So we can start there if you like. You've mentioned that this asset class was pretty volatile in the last 6 to 10 weeks, I suppose. Traditional markets coming off from all-time highs, crashing spectacularly in March, and then experiencing the most extraordinary sugar rush rally as central banks globally really turned on the printing spigots. And actually, I'm pretty proud of the way our asset class, digital assets, have performed. If you look at even though some of the mark-to-market losses at one point were quite jaw-dropping, sort of down 50%, just like the Dow Jones. So not maybe that jaw-dropping, but they've clawed back ground in spectacular fashion, or at least Bitcoin has. And really, Bitcoin has been the driver. People have been witnessing what the central banks have been doing, and they've been looking at Bitcoin and saying, okay, maybe this is a hedge against fiscal irresponsibility. And it's poetic, in fact, that just as central banks embark on their biggest easing since we've seen probably since 1929, Bitcoin itself went through a quantitative actually halved. So nice little contrasts, and life serves up these contrasts. So really, if you look at the way the market ecosystem performed, we had record volumes on the spot exchanges and digital assets in March. And even though they're off those highs, volumes are still elevated. Whereas if you contrast perhaps traditional markets like S&P 500, the rally on the way up has not been done on the same amount of volume as the decline was. So something like 2 to 1 more volume printed on the way down than printed on the way up. So it's somewhat the same in digital assets, but we're still probably 40 or 50% higher than the levels that we saw pre-crash. So that speaks to me that engagement is there. Certainly when I look at institutions entering the space, you mentioned a few, but there's some big movers out there. Some big macro thinkers are beginning to orient themselves into this asset class, predominantly Bitcoin to begin with, I suppose. Paul Tudor Jones has a couple of percent that he's allocated, not just to his own PA funds, but also to his actual funds. He's expressed this via futures, so it's not a native investment, but still it goes to show that the asset class is perhaps mature to the level that these kind of investors can look at it. And Renaissance Tech announced that it could trade in Bitcoin, and I mean, they just look at markets as a number, and this is another number, but at least they feel that the integrity is there for them to put assets to work. And then, of course, our friend Jamie Dimon has done a full 180-degree turn, going from saying in 2017 that he'd fire people for trading in digital assets to going to banking Coinbase. Quite the turnaround, and no one seems to talk about this. So anyway, that's the macro overlay. I think one of the trends that will be interesting, and a nice segue into my co-panelists, is to discuss the advent of the stablecoin. And their stablecoins are built on things like Ethereum, and all they are really are wrapped traditional assets that can be traded instantly. And so think of the US dollar. Tether is the biggest stablecoin, something like $8 billion of value carried on that construct. And crypto asset people tend to use Tether because they can transfer the economic value of a US dollar in a 2-minute period. Contrast that with some of the traditional ways of moving dollars around. One, you might not be able to send it where you want it to go. And 2, it might take a few days. And 3, it might cost you 3-4% overall. So stablecoins really are a very interesting asset class and the settlement rail for native assets themselves as well.
Great, and I think I'm gonna stop sharing my screen now, James, but I thought that was a really great segue. And we have also, so I think, has it stopped sharing now? I think so. So
I didn't see it to begin with, I'm afraid. I couldn't see a screen.
Oh, you couldn't see the screen at all?
No, but that might have just been a problem on my side, but for some reason it wasn't coming up.
So George, did you get to see the screen, or Brian?
No, I just saw yourself. Yep.
Okay. Well, sorry. When you said you could see my screen, I was.
I thought, I thought you were in terms of yourself. I didn't know.
Okay.
Never mind. I think we all got
the general gist, and what we'll be
of it.
doing is circulating the analysis to all attendees. So apologies for that in advance. But George, at KR1, you're one of the sort of the only listed crypto fund in the UK, as far as I'm aware.
There are a few
on a main market.
Yeah, well, there are
our friend Eddie Travia.
Eddie, exactly. So there are a number of listed what sort of ways into the ecosystem, but we're all very different, really, in how we approach things. So KR1 was one of the first sort of crypto funds in the world in early 2016, and so the idea was that we could create a sort of basket of tokens that we did the due diligence on, or basket of crypto assets, and the share price would move in relation to that basket. So it's a way into the crypto space, but allowing us to navigate it for you, I suppose you could say. And then there's some nice aspects to the fact that it's a public share. You can put it in your ISA, so you can sort of put it in a tax wrapper, so you can potentially get crypto gains that are sort of isolated from the taxman to some degree. So that's interesting. But also it means that we're fully transparent. Crypto funds are an interesting bunch across the world. They have many different shapes and sizes, and not a lot of it's very transparent. But as a public company, everything we buy and sell is announced, so investors can get a very clear idea of what we hold, and that's very useful to many people.
And I think, George, I got you on because you're a token market specialist, but I've also brought on Brian here because I think you're one of the sort of one of the most active issuers of security tokens in Europe, which is a small word because not very many security token people are very active, but you've actually got some offers off the ground. So particularly a real estate group in Germany that you've sold part of a building for. So what's happening with Black Manta Capital Partners, Brian?
Yeah, Black Manta is one of the few primary issuers of security tokens in the world and in Europe. It was the first to receive its license from BaFin. So it's regulated under MiFID and can passport around Europe and, well, until the end of this year into the UK. We have one public deal that is has been announced. That is, it's a small deal in Berlin, and it's open to the public in Austria and Germany. As with any security, the prospectus laws and securities laws of the country and of the EU and everywhere else apply to it. So there's a lot more restrictions compared to our Tether friends and things like that. However, I think we're at the beginning of something that will be a major industry. If we look at what's happening around the place, you look in Germany and France in particular. I know the UK has a lot going on, but Germany and France are surprising in that they don't normally lead in these spaces. But in Germany, they have authorized a bank, in Solaris Bank, to work in crypto. And out of that, you have Bitwallet and other initiatives. You have custodians who, again, are specifically authorized, or will be this year, specifically authorized by the by the regulator, and ourselves. We're specifically arranged to bring digital assets that are regulated to the market, including the public in Europe. So that's something that other countries are not willing to do. And when the biggest economy in Europe leads the way, it's a really good thing. In France as well, you probably saw that yesterday they used their first central bank currency with a transaction with SocGen. And I think that was a really big moment. And they plan to do more transactions with that central bank currency before the end of the quarter. So yeah, so with Black Manta, yeah, we have quite a bit in the pipeline. We have a lot of different assets coming our way. We would see properties, property funds, crypto funds, other types of funds. I think there's a wide variety of different assets in there, but what we see a lot of funds and a lot of property, because I think you're looking at big sticky assets that have fungibility issues, whereby if you tokenize them, you can address some of those problems. So I hope that we will see a lot more of this coming through. Like there's with the exchanges that have been built, like Archax in London and things like this, and with all of the custodians, they kind of need us to be successful to flow the assets down for them to custodize and trade. So I think it's going to be a very busy year, and we see a lot happening despite the crisis. And maybe even because of the crisis, you can issue a security in Europe now without the paperwork, as in everything is online, everything is enabled online. So you can, as an investor, go on into a regulated financial institution, onboard, and purchase your security and hold your security all without visiting a notary. So that's very positive.
I'm really pleased, Brian, that you are busy. One of our big, in our message to our traditional investors, we believe that by 2025, $8 trillion worth of value will be contained in digital assets. And obviously you got the native theme, so we expect Bitcoin that real estate, tokenizing illiquid debt, and tokenizing other things that aren't traditionally broken down into fractional ownership really is one of the big driving forces. So really pleased actually that you're seeing it right on the cold front, that things are picking up and there is real demand for it.
Yeah, I guess sort of the exciting thing about George and KL1 as well is that you've been very active in various sort of layer one protocols. So obviously early involved in the ETH ecosystem, but you're also quite heavily involved with both Cosmos and Polkadot, where you were an early investor. So what's sort of been your approach there, and what are you seeing in terms of being built on the different sort of wider chains?
Yeah, so I think for us, what was really interesting was to watch Ethereum find product market fit with DeFi. Basically, since the early Bitcoin days, what's been happening is it's just been a huge sort of explosion of innovation, and basically, developers and companies pushing out in all directions to see, what's possible with the technology. And clearly, Ethereum has found this sort of Lego blocks of sort of financial Lego blocks, they call it, where these applications can fit together in various ways. A lot of it built on top of the stability of the Maker protocol, or stability. It has its moments, but also, of course, with obviously the movement of Tether onto Ethereum. And there are other players in that space as well. So DeFi, we started our interest in DeFi way back in 2017. We invested in a project called Melonport, which is a sort of one-click shop for hedge funds, which is sort of modular hedge fund protocol, which is really interesting. But they were sort of quite far ahead of their time. But since then, we've seen obviously the Maker protocol, Compound, Uniswap, DYDX, all manner of different ways of producing trustless smart contract infrastructure to allow people to make more of their money. So we as a company decided this was obviously somewhere to focus And so early on, we backed a project called Nexus Mutual, which is part of the DeFi world in terms of being able to get cover for smart contracts. We backed Argent Wallet, which is obviously another key pillar of that. It's a sort of entrance point into the DeFi ecosystem. And so that's been and continues to be a sort of main focus. And then obviously after Ethereum came the next sort of level of experimentation, which was interchain protocols with Cosmos and with Polkadot. And I think what we see there is the ability for new projects to evolve on those layers. Whether or not new DeFi systems appear out of those protocols, we shall see. Certainly, we've just backed a project on Polkadot called Akala, which is a new idea behind how to create stable coins, and that's very exciting. So for us, it's all about staking, basically. So using tokens to effectively create collateral, or to use as collateral in order to verify the blocks within these layer ones. It's a great use case for tokens. It has a few benefits to it in the sense that when people are locking up their tokens in order to receive the yield for performing that function, it obviously locks up tokens. So that's a really interesting aspect of it, because it means that you effectively have a lot of strong hands in the system. And what that does is it allows other projects to get funded on it. Like we've heard a lot about Ethereum killers, and a lot of these Ethereum killers haven't quite performed how they'd have liked to. And I think a lot of that is down to the fact that what Ethereum was so great at, and indeed what Cosmos managed to do as well, we'll see about Polkadot, was that they actually managed to give their initial investors a serious return in terms of the token price, and a lot of that's got to do with how powerful the token is as a sort of programmable unit, and indeed how it programs the behavior of the holders. But when you give your community a major cash injection, you find that you actually you fund a lot of other projects on the system. And that's really encouraging to see. So as a VC, as someone who's looking to allocate capital, what we're really looking for is thriving layer one protocols that clearly have a large group of projects that are building on it, because that has that longevity going into the future. So for us, yes, those are our main focuses, and it's a different style of investing. You have to get involved. You have to learn what validating is. You have to learn who to delegate to, if you're not running your own validator, and so it's it's kind of like it's VCing on the one side, but it's also a lot of treasury management, working out how the system works and actually adding to these protocols themselves, adding your time and adding your energy, which is incredibly exciting as a way of seeing how the ecosystem's evolving.
And George, you actually, and in a small anecdote, and by the way, to make up in some way to the audience for our error, I'm leaving some of the slides on in the background, so, or my error. But so this is looking at the sort of price of the cryptos, and as people talk, I'll just leave some interesting information generally relevant to what they're talking about. But in terms of that, I think it would be quite interesting to address the volatility point of crypto in sort of, I mean, there were moments where effectively there were days where you could be 30% down or 25% up in trading some cryptos. I mean, how, as sort of an investor and a treasury manager, do you deal with that kind of thing? Because it's been a real roller coaster in some ways.
Yeah, I mean, if I take that, I'm sure others will have other viewpoints. But for us, really, as a very early stage seed investor, the day-to-day volatility doesn't really come into our picture. We do hold for the long term. Now, obviously, when that volatility, lasts for a period of time, in terms of Bitcoin can have a huge spike and then effectively stay there for a period of time. It doesn't always come back down immediately. Then yes, we would look to potentially sell or buy depending on where we are. But generally speaking, the movements at the moment are so quick that we're looking sort of at the 2 to 3 year picture. I mean, for example, we recently put out an announcement. We sold a very early investment of ours into a really interesting project called Rocket Pool, which has been building basically for 3 years round the clock to produce staking infrastructure for Ethereum 2.0. And Ethereum 2.0 is only just beginning to get into focus as a project. And obviously, as this is one of the only conduits into the potential sort of incoming interest to Ethereum 2.0, and so it exploded just a few weeks ago in terms of price. And so obviously we watch the market like a hawk for that kind of volatility that we've been waiting for 3 years, and we did make a partial exit there on that movement. But yes, generally speaking, the major swings of the major cryptos we just hold on for dear life and wait for the more sort of wider movements in terms of a clear bear market forming or a clear bull market forming, and we'll make decisions in that kind of time frame.
Yeah, and this is a look at actually the top 100 tokens and how they performed, and the effectively sort of like the Streamer, Hyperion, and Numerai that I was talking about earlier. Obviously, you could have netted up to 5 times return over a 3-month period, which is an extraordinary IRR in that particular group. But you at the same time, it's sort of probably the hottest outfit out there in crypto at the end of 2019, mid 2019, was Maker and MakerDAO, and we've talked earlier about stable coins. But there's clearly this issue that in crypto, which I think excites a lot of people, but also makes it quite perilous if you're not paying attention. How do you sort of get around that if you suddenly had a sort of darling project like Maker that you were involved with, and maybe we can talk about the topic of DeFi as well, and in that respect is how do you, with these sort of very hotly anticipated projects that run into difficulty, how do you deal with that?
I mean, it's difficult because it's sort of so contextual to the event itself. So when you look at what happened to Maker, effectively you had a black swan event where the precipitous fall in price was more than potentially the system had been tested before. Combine that with the difficulty of the Ethereum network and the gas price and the congestion, and effectively you ended up in a situation where people couldn't cover their CDPs, their collateral debt positions. And at that point, the way I understand it is that there is a system that liquidates the collateralized debt positions that haven't been or the owners haven't had the chance to refill, and at that point you rely on a sort of system of bots that effectively buy up those CDPs, and again, due to the gas price, most of those bots weren't functioning. I think there was possibly just one that was. And in all of these sort of I suppose sort of highly unanticipated events happening, there was a shortfall in what Maker required in order to sort of fill its debts against what DAI how much DAI was in the market. And so it's had to, which is what the maker token is for, it's had to devalue the maker token by printing more, and that's why we see this price decline. So that's my sort of a layman's view on what happened with Maker. I suspect that James probably has a more in-depth view than me, but I think it's now a case, if we were heavy holders of Maker, it's a wait and see game, really. You have to sort of take it on the chin to some degree, but realize that actually Maker is now stronger than it was before, even though the price doesn't reflect it. It's been tested in a way that it could never have tested before it was released to the market. These kinds of things can only be found in the wild, and now because of how the system will be tweaked, it won't happen again, or at least not in that particular way. So they are anti-fragile to a degree, these protocols. So Maker has the biggest moat in terms of trust, even though that trust has been hit recently. I think it goes a long way in terms of people, deciding to continue to trust it. And so if we were, we're not huge holders of Maker, but if we were, we'd stick it out and be confident that it would return.
Yeah, no, very, very interesting. I think I'm going to segue into sort of talking about the institutional and mainstream interest in crypto. So first turning to James and then to Brian, because both of you sort of are working as sort of bridges between the mainstream finance world and the crypto world, and to a certain extent George as well, because people can just go onto a main market in London or one of the junior markets in London and pick up your stock. But the sort of, I guess, James, what's your take? I mean, you've got a sort of traditional finance background. You're now very focused on sort of trying to make traditional finance people comfortable with crypto and Bitcoin as an asset class. What's clearly the groundswell, I guess, when people in an institutional background see a huge rally and that it's tradable on a futures market, that's exciting to them. What positives are they looking for comfort about crypto, and what are their major concerns?
Yeah, no, thank you for that. And I think Adam Bloomberg in his in the chat has asked a question saying, how are investors seeing crypto? I'll leave the security tokens part to Brian, but it's correlated to your question about volatility. Like at first blush, crypto markets may appear volatile, and that is certainly true. That's true on an intraday basis and perhaps on a daily basis. But when you look back at where Bitcoin's come from 2009, actually on a yearly basis, the returns, the Sharpe ratio returns of just even a buy and hold strategy it's pretty incredible. And so, volatility is a double-edged sword, I suppose. And so if you have big moves, you can actually position size so that you can risk adjust it the same way that you would buy, I don't know, US Treasury bond. Something that's not volatile, you buy more of, and something that's very volatile, you buy less of, because you get the same sort of economic participation. So that's in a completely non-macro neutral perspective and just a risk allocation perspective. But I think when you start saying that, okay, these asset classes are maturing as an asset class such that institutions now are comfortable investing, they might not say, okay, let's put 50% of our risky allocation into digital assets, but there's nothing wrong with putting 1 or 2% into that. And there's some analysis that's been done that if you were to have just added 1% of your allocation to digital assets to your portfolio, you would have increased your overall portfolio returns by 8 or 9%. And so, you have some uncorrelated returns that are available here that, given this macro situation whereby central banks are printing money and risk assets are appreciating. I think I have a chart there that shows, if you wouldn't mind, just shows the performances of gold, Bitcoin. Thank you. Just the one before. thank you, and and the S&P 500, then you can see that actually the moment that this QE Unlimited really kicks in and the stimulus checks start hitting people's bank accounts, gold, Bitcoin, and S&P 500 respond. That's really interesting because it's beginning to serve as a macroeconomic hedge. And as I mentioned earlier on, you've got these big macro thinkers who are now convinced that this asset class is a mandatory investment vehicle. And I think that once you get this crescendo of noise coming from people like that, institutions are now on the hook from a career perspective and must start looking at this space. I don't think they can say, okay, we're not going to bother with this at the moment, let's look at it in 18 months anymore. You know, I think they're going to be, the questions will be asked if markets continue in trend and the asset class is 3 or 4 times the size this time next year or in 4 or 5 years' time. Questions will be asked, what were you doing with my money? Where was my allocation into this asset class? I don't think you can say, I don't like it, I'm not putting you in. I think you have to say, I've looked at it, and here are the reasons why I'm putting you in, and here's why, and I stake my career on it, I'm not putting it in. So that's, I guess, something that that we're beginning to see now. And Novogratz actually came up with he set up a dealer broker at the top of the hype cycle last time around, 2017, 2018. And he had crickets for years, for a year, 2 years. But now that they're busy, you've got institutions phoning up saying, how do I get an allocation? How do I do this? And that's kind of what we've been waiting for.
Yeah, and it was, yeah, I mean, Novo's been a great sort of advocate of the asset class, although I think Galaxy came under a lot of fire in the sort of 2019, late 2018 period, just because of how interesting that was. But I think getting first in, and it's the number of smart people that you can name that have backed the asset class is pretty extraordinary. I think, Brian, in terms of the, I guess, next wave, so I'd say that the Bitcoin and the Bitcoin futures market have clearly been, so we've got CME here. This is a way that anyone who's able to trade on the Chicago Mercantile Exchange can sort of access this market. I think the other area is George's trading these sort of traditional cryptos are typically non-regulated securities and hard for a traditional asset manager to hold. I think a lot of people have got excited about the concept of security tokens and digital securities. And Brian, you're actually doing some early ones. How are you seeing the institutional interest go into this very nascent asset class of security tokens?
I think nascent is a good word, but we do see lots of things happening. So I think that the infrastructure, like I was talking about earlier on, with custodians and regulated financial institutions to work with these institutional clients is now existing. A couple of years ago, these things didn't exist in a regulated way, that somebody who has a fiduciary duty to a pension fund or something like that could realistically say, okay, I can interact with these companies. So where we are today is these now exist. So you can trust that, or if not trust is maybe the wrong word, but if you have an obligation to work with regulated counterparties, you can now do this. So that's a positive something. It's not going to, just because you have the infrastructure doesn't mean people are actually going to come, but it does open it up to people participating in the market. And from the partners that we work with, we do see that institutional clients are onboarding and are setting up accounts and getting ready. So we're hopeful that when they're ready, they will start executing. There was one other point I had, but my son knocked on the door and I forgot it.
But I'd like to pick you up on actually where you've been doing, because this commercial real estate transaction that you're still issuing at the moment.
Yeah.
So at least if you're able to talk about that in general terms, the sort of, it's pretty interesting to me that I think it was a £12 million or euro building that you sold nearly 1 million of at the moment. How has that process been for the issuer, and what do they get out of it that they don't do by going to a REIT or something else?
The issuer behind this is actually somebody who is has a technology background and has done quite well out of it. So they're also an enthusiast. They have many different properties, and they're looking at this as an alternative way to help finance some of those projects. So this is, from his perspective, it's an experiment, and he's testing out how things work with it. So far so good. It's not all sold yet, but he's happy with how it's going, and he would like to look at other options to do more of this sort of thing. So I suppose it's in a property deal. So this is a property development in Berlin. The reason the size of the deal is as it is that because in the prospectus directives and how it's implemented in Austria and Germany, if you keep it to that level, the level of bureaucracy when it comes to paperwork is a little bit less, and that's how it can be a public deal. So the threshold is quite low for investing. And that means that deals, so a commercial property, it's a residential property development. So typically, investors would have great difficulty getting exposure to such projects. And in this case, you're opening it up to people who wish to participate and take an investment at that stage of a project, because before that would really be professional money that would be in there. So, so I think, how's it going? I think we wish we didn't have COVID and everything else to compete with for getting news and attention. It's slow enough on the retail side. We have more interest probably from professionals, but the issuer is happy. It's progressing, and from his perspective, it's opening up new possibilities for the future, for future developments he has in mind.
And I actually say that's pretty exciting, because you couldn't even show people around a property in the UK, at least, for like a 2-month period. And this guy managed to raise £1 million for.
I don't think it's quite at 1 million, but
yeah, nearly. So, but it's interesting that you can get any form of liquidity in something where I think it's generally pretty hard to sell any real estate assets right now, as far as I can see. But
yeah, and there's other very interesting things as well because of the nature of the token. We have lots of, even though it's very small, we have lots of people, because there's a lot of infrastructure built, wanting to work with us to see if they can do things with it. So it's very small, and it's it's a bit niche, but it's got a lot of attention, because I think it's the first kind of cross-border public one like this that everybody can participate in. Mm. So hopefully we'll see a lot more of them. And
where can you buy it? Sort of.
You have to be an Austrian or German resident, unless you're a professional investor.
Okay, so it's cross-border, Austria and Germany. It's not.
Yeah, it could be in other countries, but
American dream of that George luckily is able to participate in, like the non-regulated security environment is pretty extraordinary from that perspective. And
well, one thing we can do that I don't think many others can is we can accept Bitcoin and Ethereum, because we're able to AML and KYC it. So there is a sort of there's a bridge between I don't know, a property like a building and Bitcoin, and we will see more of this sort of thing.
But George, interesting. You've obviously experienced like the insane globalization of tech, and I can remember this was one of the things that most struck me way back in 2017. I got invited to Lithuania, where they had 2 $30 million ICOs. I don't think the tech community in Lithuania had ever had projects that had raised 30 million, not 2 in one small country in Eastern Europe. So that weren't located in Silicon Valley, having been founded by people from that country. It's a very interesting phenomenon, and I think how do we, so obviously the sort of Brian's dealing with the regulated trickier markets, and crypto companies are dealing with all sorts of different regulatory issues. But one of the great strengths of that market is how globalized it was and is. And how are you seeing that pan out at the moment?
Yeah, certainly. I mean, there's pros and cons to it, right? So when regulation is there, in certain markets for a reason. I'm not going to have an opinion either way on which elements are good and which elements are bad to regulation, which countries do it right and which countries go perhaps a little bit too far. But what we saw was a huge explosion in this idea that you could put forward a utility token, as I suppose they called them back in them days, and sell that as a way of getting income into the company or into the project. And in many things like we see in crypto, everything is kind of sped up and slightly sort of rocket fueled in terms of the speed of these things. And we were seeing projects come to market after sort of 3 weeks having done their crowd sale, and the money was beginning to get slightly extraordinary. And I think overall it was a fairly natural thing to see happen. I think there's a lot of people that want to invest globally. I think a lot of people can't. And then it was permissionless, and so everyone had a go, both from the sense of people actively trying to allocate capital to things that they felt were good, whilst at the same time project prospectors, I suppose you could call them, that were throwing their white paper in the ring to see what would happen. Really, I think there was a huge misunderstanding that never really got proper airtime about 2017, and that was the fact that doing a token sale is really about geographically dispersing your token across a wide enough group of participants in order to decentralize the protocol. The fact that you could sell those at a future value of what the protocol might be worth, is really where things began to sort of become unraveled. And certainly back in the early days of Ethereum, the first few projects that tried this were actually really fascinating projects. And the tokens, even some of them to this day, are actually like what you would want to go and look at as a token that's worth looking at, because they were the participants were really actively trying to understand what is the benefit of having a token, because it's not really a share. And that's where a lot of the companies have come into problems, because they were like, buy our token, get some revenue, and that's really where a lot of it ran into problems. What we're seeing is actually the maturing of that market. The token is essentially a programmable asset, like Bitcoin is a token. The whole of Bitcoin rests on the value of the Bitcoin token moving around the system, effectively reimbursing participants for their participation in the network, which makes the whole network float. And that doesn't end at Bitcoin. It moves into Ethereum, it moves across. It just depends on what the project is, what the token is designed to do. And that's why we very early on started looking at staking, because this whole I've built a protocol, go and buy my coin so you can use my protocol, was just never going to work, even in the early days. There's too many hoops for people to jump through, and there isn't any real benefit to that. And what we're seeing are projects like Augur, for example, which was one of the very first products. It's Ether that runs through that system, right? And with the version that's coming up, Maker's DAI as well, the stable coin. The Augur token is actually designed to program the community to behave in a certain way, which in the case of Augur is provide a security backstop against resolving the various prediction markets. So when you have a product that you're trying to decentralize, the token is that system of value that moves around the protocol and rewards people for particular behaviors. And that's, if you're looking at this world, that's really what you have to look at. You have to look as to what the token is attempting to do and what behavior it's trying to elicit. And yeah, that's what
we had a number of great questions from the audience, and so happy to take more as well. But the there's so Adam Bloomberg was asking again, is there a big need for education for advisors, investors, and developers in building? I mean, explaining the concept of staking, I think there's probably an even smaller number of people that understand staking than security tokens in some ways, George. So it's sort of how do you increase good education about these markets? And
yeah, it's a great question, because it is to actually just talk to go back to my last point. It's education that allows something like 2017 to happen, right? Because people didn't have the resources to really understand that there were only 5 or 6 use cases for a token, and the fact that we were having $700 million ICOs is probably not straightforward. So as a company that has one foot in the crypto world and one foot in the retail investor space, and the public markets, education is really actually what I've been doing, since I first got into the space in 2012. KR1 actually grew out of a meetup that I was running with a friend of mine, to try and educate people as to what was going on, to people who are interested in being educated. We're in the public markets, and that's how KR1 was born. But yeah, so it's basically round the clock. We write our RNSs, our regulatory newswires, when we purchase something, or when we sell something. We have to describe why, what is it, what's exciting about it, and we have to do it in terms that the market, the retail investor will understand. And that's not always straightforward, because if you have to have an idea of Bitcoin to have a clear idea of Ethereum, and then to get an idea of staking. I mean, it is an onion, of course it is, but hopefully it's a big enough rabbit hole for people to fall down. All I would say would be that when you see, my best advice would be to really go and try and look at DeFi, right? This decentralized finance that's happening on Ethereum, and just get some Ether, work out how to get a wallet and make it happen, and then go and start, loaning tiny amounts of Ether and seeing how the whole system works. And when you find that you can do things that would take you months in the real world and a huge amount of paperwork, and you can do it in seconds, and you're basically talking to smart contracts and algorithms rather than human beings, it kind of gives you the goosebumps. And you although it's pretty early right now, and these systems, they do fall over from time to time, you get a sense of how powerful this technology will become, and that's a rabbit hole well worth falling down.
I think it's just generally been a fantastic discussion, and I think I think we're coming to the end of the hour, but also in education, I think it's a big driver of what we're trying to do, both with our Novum Insights data business, my partners CryptoCompare. It's all about, like, the driver of what we do is just educating, providing people the data, the information, where they can make rational, smart investing decisions in all areas in the field. But I think, sort of, in terms of trying to wrap up, sort of, where does this asset class go 1 year, 3 years, and 5 years? Very quickly, both Brian first, then James, then George, I guess.
I'm an optimist. I think that we're at the beginning of something here. When I look at digital assets, I don't look at it like Web3, I look at it like derivatives. I think we're at the beginning of being able to create things, and I think we're at the beginning of a cycle of innovation in finance. So I think it's going to be growing. As George was saying, it won't be without hiccups and things falling over, but it's going to be an exciting time of innovation.
James? You're on mute.
Sorry, I'm mute. There we go. I gave our predictions earlier, so we see the asset class being worth $8 trillion by the end of 2025. Bitcoin north of 100,000, that sort of thing, and hopefully a lot of value carried in tokenized real assets, but also native digital ones.
And George?
I can concur with both. It's from from the early days, the things that we're seeing now, you couldn't have drunk enough Kool-Aid back in the early days to have imagined that they could have been possible. And yet here we are. And sometimes the market doesn't even move, like particularly like it used to be, like, you know, someone would sneeze and the market would drop. And now, you know, you have some of the world's biggest macro traders putting Bitcoin into their portfolios, and the market's like, but of course that's going to happen. So it's come a long way, and we've got so much momentum. Myself, like the other guys, I feel like it's only going one way.
Yeah, and in some ways it's been a kumbaya crypto session because we're all believers, but at the same time, I think like the reason why I wanted to get experts was actually like I think you're getting more and more stuck in the mud if you're not at least taking seriously Bitcoin, and then all the other evolutions are probably much more serious. But the financial interest that we're getting right now from the world's biggest information providers and the world's sort of biggest investors is huge, and I think it probably isn't going to go away. Very cool.
Yeah, it's still a market that can go into gyrations over 50 Bitcoin from an old wallet moving, while everyone misses that the Bank of France did its first central bank euro.
Yeah. Well, as we showed, it can go down 30% in a day. That's scary, but it's not for the faint of heart. Let's say that.
A mere flesh wound.
Yeah. Well. Yeah. Anyway, leverage crypto trading. Aware. But anyway, very good. Well, thank you to. I think it's been a really lovely session. To the audience, we'll be sending out all the full research that we've prepared as well, and it'll be going live on the web.
Fantastic.
Thank you. Thanks for having me.
Cheers.
Thank you so much, Toby.
Pleasure.
Thank you.
Bye.
Cheers then. Bye.